Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to do a video that's a little bit out of the norm from what we regularly do. Usually we talk about something in regard to the economy, to the stocks we might be buying and selling, updates about the stock market, and just basically investing in general. But today what I want to do is I want to review some of the portfolios that some of my subscribers have left me. I've seen a lot of other YouTube channels where people review their portfolios, and I've had two in the last couple of days that have left their portfolios for me to review, so I thought, why not, and just go ahead and make an entire video dedicated towards reviewing these guys' portfolios. I've seen these two guys in my comment section several times, so I thought, what the heck, I might as well at least take a couple minutes out and then make a video dedicated towards reviewing their portfolio. So first off, to get started, I have not seen these portfolios at all ahead of time, so I'm going to be viewing these in real time. This is not financial advice. I'm not a licensed professional. I am just some random guy on YouTube, but I do have about 2 years worth of experience in investing, and maybe my opinion will give you some insight on what I think about these stocks and a little bit about my investing strategies. So I'm going to be going over both of these portfolios, and before I break them down, as you can see here, I show my link at the beginning of all of my videos. I have 14 successful referrals at the beginning of this video. Let's go ahead and get that to 15. This link is in the description of all of my videos. So while I break down these portfolios, if you like the M1 Finance platform and you're interested in using this, go ahead and use this link right here, and you can get $10 just for using my link, and you can get started investing in your own dividend portfolio. As you can see here, you see these four little slices here are a little bit funky. There's two slices that are really overweight that are sticking out, and then there's two that are really underweight. I'm not going to hover over them because I'm going to save that for the end of the video. Just like with all of my videos, I'm going to save that for the end of the video when I review my own portfolio. So if you're interested in seeing that in the two companies that I recently added to my portfolio, which I will be buying into Monday, and then the two companies that I'll be selling part of my position in, I will be going over that at the end of the video when I review my own pie. So if you're interested in that, watch all the way to the end of the video, and let's go ahead and get started. The first portfolio that is being left to me here is by Jose Gonzalez. I've seen him many times on the channel. We're going to go ahead and read his email here. Hello, thanks again for reviewing my portfolio. Below is the link to my portfolio. Just for some clarity, I plan on having no more than 45 holdings at any time, with just about 5 of those being stocks for growth. I focus mainly on dividend investing with M1 Finance, but also want to invest in companies with future growth potential such as Facebook, Square, and Tesla. You are going to do very good in Tesla. I've mentioned many times on this channel, many times, is that Tesla is the one non-dividend paying company that I've considered adding. I think in the long run, I know just recently I mentioned that they broke $1,000 in share price. I think in the long run, this company is going to be $2, $3, $4, $5,000 many years out from now. So you can't go wrong with Tesla. I don't know so much about Square and Facebook. I mentioned that Facebook is actually one of the top holdings that I would recommend that isn't a dividend paying company. It was one of the first stocks I ever recommended on this channel. Square, I don't really know a whole lot about, but definitely with Facebook and especially Tesla, you can't go wrong with those. So good picks. You're going to notice that I have a couple of companies that have cut their dividend. Initially, I was going to sell them, but since I am in this for the long run, I wouldn't mind having those companies in my portfolio for growth. I'm also hopeful that they will return to paying back dividends in the next couple of years. I apologize if this message was longer than anticipated. Thanks again for looking over my portfolio. Now, first of all, that message was not longer than anticipated. I would like to get some more information about how old you are and what your goals are financially speaking with this portfolio. Are you looking at it for income? Are you looking at it for retiring early? What is your goals with the portfolio? So I'd like to know that, but that's the information I have. So let's go ahead and get started with this portfolio. Okay, so first impressions before I dive into it, I see it has 45 holdings. Right now I have about 31 in mine starting Monday. I added one more. I just said in a previous video that I made about diversification where I said in my opinion about 20 to 40 holdings is about what I feel comfortable with, and I think 45 is a perfect amount to have. There's no right or wrong answer to the number of holdings that you should have. I see that you have 3.413% dividend yield. That seems just fine. Nothing that's completely out of control or out of hand. The expense ratio is 0, so like me, you have no ETFs in the portfolio, so that's really interesting. And this is sorted by greatest weight. So let's go ahead and get started in this portfolio. And I can see the 5-year performance for this portfolio is about what mine sits at 51.33%. So that's not a huge importance whether it's up or it's down. It doesn't really matter in the long run what your stocks have done. It matters where they're going to be. But definitely in a portfolio of 45 different companies over 5 years, you definitely want to see it in the green because there's a problem if they haven't been in the green in this bull market. But it does not guarantee future returns. So I wouldn't focus so much on that. But let's go ahead and start looking at your top holdings. So already here, before I start breaking these down, the top 3 are already some of the top 3 in my portfolio. You can see my top 3 holdings right here: Broadcom, Realty Income, Visa. So definitely some similarity there. I don't know if you got that from me or if you just came up with that on your own. But Broadcom and Realty Income are the two top holdings at 5%. You know I'm not going to argue with that because those are the two top holdings in my portfolio, as well as Visa being the third holding as well. But for the long-term outlook between Realty Income paying monthly dividends and them being arguably the best well-run REIT in the entire stock market, you cannot go wrong with Realty Income. They have outperformed the market since they went IPO'd for the last 26, 27 years, whatever it's been. But overall, Realty Income, whatever it is, it's just a great company. Overall, if you're interested in getting into real estate, especially real estate investment trust, that is the company you want to go with. So great pick there. Long term with Broadcom, I've made several videos about this and explaining all three of these companies, but basically with Broadcom, the future growth potential that they have with tech between their microchips and all the other software services that they provide, I think long term this massive dividend yield is going to get even greater. So great pick there with Broadcom. One of the best dividend growth companies out there in my opinion, as the dividend growth has been massive. I think it was about 40 cents a share. Yeah, you can see here in 2015 it was 40 cents a share and now it's up to $3.25. So about an 8 times in just 5 years on dividend growth. So massive. Speaking of massive dividend growth, Visa, I think for the long term is going to do great. They've grown their dividend from 12 cents all the way up to 30 cents. So massive dividend growth there as well. I think long term they're going to do just fine. And then we're going to get into the next stock here, the fourth one, which is Philip Morris. Now I own Altria Group, which is basically the same thing as Altria. Now, Philip Morris does have a slightly lower yield. They have a 6.6% yield, which is massive, just like Altria. They operate at a high level of leverage, and there's not a huge amount of dividend growth here, but I think with the massive yield and the gradual increase in dividends that you'll see every year, I don't think that this is necessarily a bad play. I'm not sure if they've cut their dividend. I do know that they are at a decent risk of cutting their dividend, just like Altria is, but I think for the most part, Philip Morris should be safe if they're anything like Altria is. AT&T, so a little bit of a teaser here. I mentioned that I changed 4 holdings in my portfolio. I added 2 stocks, and then I sold my holdings, part of them anyway, in 2 of them, and one of them was AT&T. I'll make a full video on this, why I'm planning on doing this on Monday, but the reason is there's been a lot of management issues, and I think the long run, I kind of got manipulated from the high yield and the whole commonality of the stock market of everybody being so hyped up about AT&T, how they're recession-proof with their dominant market in phone services. But overall, I just think AT&T has a lot of trouble ahead, and with that high payout ratio, I think eventually that dividend is at a very high risk, and regardless of that, the dividend growth is extremely slow, and I think in the long run, I would probably be better off just putting my money somewhere else. So AT&T, definitely not a bad company to invest in, definitely not advising against it, just not something that I totally am 100% on board behind. I have this company as well, so I'm definitely not going to knock it, but AT&T definitely at a high holding, so just keep that in mind, just like with Philip Morris, not a lot of growth there, but some high yield, so if it pays off and they keep those dividends, you will get a massive return on it. Waste Management is a company that definitely has a bright future ahead of them. They're one of the safest, most recession-proof stocks that I can think out there in the stock market. They do have a pretty decent yield. I believe it's around 2%. So yes, exactly at 2%. And they did raise that dividend about 7 or 8% this year from about 51 cents up to 55. And I think the long run, you can see the massive performance here over the last 5 years of 114%. I think in the long run, in both dividend growth and in share price, this is one of the largest holdings for Bill Gates for a reason. People are always going to need to create trash. As the population grows, as we get more wasteful, people are always going to create trash. People are always going to need something to do with that trash. Waste Management is going to be the dominant player in that. They're already one of the largest trash companies in the world, and they're not going away anytime soon with their very sticky customers. Nike is a company that I do not own. The brand alone is what most of the pricing power comes in. People will pay 2, 3, 4, 5 times as much for shoes made by Nike than they would by others. So great pick there with Nike. It's not one that I'm interested in owning in because of the slow yield and the little bit of an overvalued, but I'm definitely not against that. Goldman Sachs. So the bank stocks are a little bit tricky right now. I've kind of been conservative on the bank stocks in general because this scenario that we have with the economy is a little bit different than what we've typically seen. I will say I do have some pretty massive dividend growth with Goldman Sachs. It's not a stock I own, but it is one of the larger, more well-run banks out there, so totally not a bad pick there with Goldman Sachs. Discover Financial Services, those of you that watch my video know, I was up over 110% at one point on Discover Financial Services. This stock has recovered massively since its recent dip, and it does have pretty good dividend growth. I also love Discover as a consumer, and that's part of the reason why I own them, so great pick there with Discover. Coca-Cola, another great pick as well, a very long-term dividend company. Apple, I can't go wrong with Apple. I mean, if you bet against Apple, you know it's just going to be a mistake. You can see that this company hit all-time highs just a couple of days ago with pretty decent dividend growth. I would say with Apple, they are more focused on share buybacks and dividend growth, but whatever returns money to shareholders, that company has amazing pricing power and amazing products that consumers are completely dedicated towards buying. So Boeing. So I made an entire video dedicated to Boeing, and it is by far the most views I've ever had on a video. It has like 3,000 views from the time I'm filming this, and their dividend growth before this recession was massive. 91 cents all the way up to $2.06, so about a double up. And I think long term with Boeing. So regardless, let's get rid of their dividend. Let's forget that exists for a moment. Regardless of their dividend, I think in the long run, talking in regards to share price, I think that if we fast forward 2, 3, 4 years from now, this stock will be $300, $400, $500, right back to where it was, and then it even hitting all-time highs. When they get past this 737 MAX situation and they get past all the negativity that has been around them, I think that they're going to do just fine. So with Altria, I didn't see that you own that as well. Same thing as it would be with Philip Morris, the same scenario, huge dividend yield, but also some potential risk. So just keep an eye out on that one. Verizon, once again, pretty much the same thing as AT&T, but with a little bit safer dividend. I don't think that their management decisions have made any of the bad moves that AT&T has. If you are considering dropping AT&T in percentage weight a little bit, I would recommend replacing it with Verizon. If you wanted to make these 3 and 3%, I would recommend that totally because Verizon has not made a lot of the mistakes that AT&T has. So this is really interesting. So Wynn Resorts. So it's really funny that I see this stock in here because I really wonder what share price you bought this at. I remember when my uncle, I was telling him about stocks to invest in when we were at the March lows, and he was like, okay, Jordan, what stocks should I be investing in? I don't really know too much about stocks, but I'd like to get some big names I think could have some huge share price potential in the next coming years. One of the stocks that I recommended to him was Wynn Resorts. I believe he bought this at like $60 or $70 a share, but he's done very well in the stock. Wynn Resorts, when it comes to a casino perspective, is my favorite stock by far. That and El Dorado Resorts. I've looked into this company quite a bit. I love to gamble, and I think that you will not go wrong with this company. They have cut their dividend, but in regards to share price, when the economy gets back, this is one of those stocks that in recession times, it gets hit the hardest. But during economic booms, they absolutely explode in share price. So you can't go wrong with that one. Starbucks has added that as well. Target is one I've considered adding. I almost considered adding that as well. I made a video about that. PetMed Express, I can't even give an opinion on because I'm not really too familiar with the stock, so I'm not really sure. That's the only one I'm not sure about so far. Procter & Gamble, very good, safe company. Can't go wrong with that. Lowe's is the one that I considered adding, but I ended up deciding to go with Home Depot, but I've still considered adding this. Nokia. So Nokia is one that I'm not too familiar with. I know the company and I know what they do, but I know they're at a bit of a turnaround play with management recently making some decisions to try to adapt to 5G. So this is a company that I wouldn't really recommend a whole lot, but I don't really know a whole lot about them to give a full opinion. So IBM is one of the companies that I ended up dropping in my portfolio. You can see the huge overweighted slice there. I will be giving the details on that on Wednesday's video if you want to hear the details about that. Honeywell, I just made a video about that one as well because I did just add that to the portfolio. This is one of the best industrial companies for dividend growth out there. You can see the massive dividend growth for an industrial company. Honeywell is the one that you want, and they make some very great products, and they are extremely diversified. JP Morgan Chase, one of my holdings as well, one of the largest, better banks out there. Johnson & Johnson, the only healthcare company that I own, arguably the safest dividend company in the entire stock market. AAA investment grade company. They are absolutely a wonderful company to own for both a dividend perspective and just the company in general as regards to their share price. Now, those of you that watch my videos, and I know Jose Gonzalez, you watch my videos, I know you know what I think about Chevron and Exxon. I don't like the energy companies, but I will say it this way. If you are going to own one of the energy companies, Chevron is the one you want to go with. That said, I'm not a fan, but I definitely am not going to be against adding some energy into your portfolio. So far, I know we're almost getting to the end here. We're getting pretty close. I will say, so far, just generally speaking, I'm really impressed. I'm really proud of you. You really have a lot of good holdings. We have a lot of similar holdings, but so far, with the diversification and the percentage holdings and the number of stocks that you own, I am really impressed, and I'm getting back to that long-term growth. So as we can see here, next we have Caterpillar, a pretty low weight. I can understand why someone would probably want to lower weight that while we're in a recession right now. I wanted to take advantage of the low share price and the recent dip in the market that we've had. But overall, I think this company is going to do great long term. I've made videos about Caterpillar. Now, this is one of the few stocks that I will say I haven't liked in the portfolio. Ticker symbol PLAY. Dave & Buster's, I haven't looked into a whole lot, but generally speaking, I know that they are very heavily in debt, and I do know that there was a lot of rumors about them even being able to make it out of this recession. So I do think they will probably bounce back since this recession is not as bad as we thought it was going to be, but I would like to say that I would like to do some more research, and I'll probably get back to you, Jose, but overall, generally speaking, I haven't heard very many good things about Dave & Buster's, so I'll look more into that and get back to you. Clorox Company, a great company. Aflac, one of the companies I considered adding. AbbVie, a great pharmaceutical company. 3M, one of my holdings. Microsoft, one of my holdings. AIG, I'm not really sure about that one. Disney, I think people pretty much overvalue Disney at my point. I'm definitely not against this company in regards to its share price, but as far as a dividend payer, I hate that it only pays semi-annually, and you can see that this company is not as dedicated to that dividend as a lot of other companies would be, as they already cut theirs in the recession. But I think in the long term, as far as share price gains go, this company is going to do absolutely fine with their streaming service, with their parks, with their amazing characters that people fall in love with. I think it's an overall great company, so definitely not against investing in it, just not one I'm interested in. This company I've never even seen or heard of before. PPL, I believe they're a utility company. I know they have an extremely high yield. I haven't done enough research into them, but basically if they're a utility company and they're safe, a lot like the Southern Company or Duke, then I'm sure they're a great buy. And they are just a small percentage of about 1% of your portfolio, so that's fine. Marathon Oil, you know how I feel about energy companies, so not a big fan there at all. Nordic American Tankers. So Nordic American Tankers, everybody's getting hyped up about the tanker stocks. I think if you want to have a small 1% as a speculative play, which I'm sure this is, I'm sure this isn't a long-term hold of holding 10, 15, 20 years. I'm sure this is probably hold for the next 6 months and then see what happens. If that's the case, power to you. It's 1% of your portfolio. Have some fun, but as long as you're not trying to own the stock for the long run, you can see how that works out. So whatever, go ahead and have fun with that 1%. I'm not a big fan of Nordic American Tankers. And then Foot Locker, I made an entire video on. I did sell out of it on my position because they did cut their dividend, but on a valuation standpoint, I think that Foot Locker is so undervalued. $30 a share, this should be a 40, 50, maybe even a $60 stock in the coming couple of years. So I think in share price gains, you'll do very well in that stock. So overall, generally speaking for the portfolio, 3.4% dividend yield, 45 holdings. Man, you've been watching my videos. You have a lot of the same companies I do. I think you're doing great. I think this is absolutely amazing. When I come up with my video on Wednesday with AT&T with my recent decision to cut part of my position in them, I'll really be interested whether or not you'll be doing the same and be upping that position in Verizon or replacing it with someone else. But yeah, overall, it's really hard for me to even find anything that I would recommend changing in your portfolio. A lot of these companies are great dividend companies. So, oh, and I forgot to review the long-term growth pie. So this is the percentage of your portfolio that is no dividend, that is just focused on growth. And wow, like I said, with the one exception of Square, I don't know. What I would probably recommend doing if you wanted to just focus on growth and not worry about dividend, they do pay an extremely small dividend. I would probably recommend adding Nvidia instead of Square, but Square is not a bad buy at all. I don't think they have as much of a dominant economic moat behind them as such as Nvidia or Facebook or Tesla or Alibaba would have. But the Chinese Amazon, they're definitely going to do great in the long term. Facebook, by far the best balance sheet in the stock market overall. Absolutely no debt, billions of dollars worth of cash. They're going to do great. And then you know how I feel about Tesla. This is going to do great long term, and you can see how the share price has performed in the last 5 years because of it. So great buys there. If I were to pick 3 of these stocks, one exception being Square, 3 of these stocks, especially these top 2, these are the 2 that you want to own for long term growth. So great picks there. But overall, you're not too exposed to energy like I always recommend. You do have 2 companies. There are small weightings in your portfolio, and most of your 1 and 2% are the stocks that are very speculative plays. So that's fine if you want to have some spec plays that could get you some big returns like a Foot Locker or a Nordic American Tanker. So that's perfectly fine. But overall, the top 40 of your 45 holdings are absolutely great long-term companies. So I think that you made a great portfolio, Jose, and I look forward to hearing back from you. Great portfolio. Okay, so next we have Joel. He did leave his portfolio here in the comments, and he wrote me a small little paragraph here. He said, "The millennial investor. Absolutely, I am 32 years old. I don't have a lot of money because of medical problems, and it makes it difficult for me to obtain the best employment. I am working 2 jobs though, a dollar cost average every week. My goal is to keep compounding my dividends for passive income." Okay, so you're just looking for passive income for the long term. Let's see how your portfolio's done over the last 5 years. 47%. It has a dividend yield of 3.273%. A very, very small expense ratio, so I'm assuming that you probably have a couple ETFs here, probably about half and half if I were to guess, and then probably have some Vanguard ETFs. And you have 60 holdings. Wow, so a lot of holdings. And let's go ahead and get started in the biggest pie here, the dividend ETFs. So overall in this section, I see that you have 7 holdings, a 4.1% dividend yield, a 0.11% expense ratio, and I think that with SPHD, I did make an entire video about it. I do think SPHD is a little bit overvalued and people look up to it a little bit too much. I'm not the biggest fan in the world, but I'm definitely not against it. So overall with all these ETFs, I won't go through these one by one, but this is extremely diversified. You will have tons of different holdings. You wouldn't have to worry about the long-term growth of these companies because you're in so many different dividend companies that it's hard to even get a gauge on what you own. I'm not the biggest fan either on ETFs, but this is some great diversification here. Okay, next up we're going to pull up consumer staples. We do have some ETFs as well as some individual companies. We have Vanguard's Consumer Staples Index Fund, a 0.02% expense ratio, 2.95 dividend yield, and 7 holdings again. So we have Vanguard, which in my opinion, Vanguard has the best ETFs all around, just generally speaking. Some of the names you have in your holdings: PepsiCo, Procter & Gamble, Kimberly-Clark, Coca-Cola, Walmart, and Walgreens Boots Alliance. I'm not a big fan of Walgreens or Walmart. I do think long-term Walgreens will do just fine as well as Walmart, but with Walmart, their dividend is so low it doesn't really get me all that interested, and their growth is not pretty impressive either. I think there's a lot of other great companies you can have out there, and I think Walgreens Boots Alliance has a little bit of a trouble ahead of them as they've been in a lot of debt and haven't been able to get through this recession as nice as a lot of other companies have, but definitely not against any of these companies. And I think generally speaking, these companies are going to do great, so not a bad slice whatsoever. Next up, we have technology, which is the third largest pie here. We have Microsoft, Apple, and then we have an ETF, Vanguard Information Technology Index Fund, IBM, and Intel. So out of the 5 holdings here with a 1.5% dividend yield and a 0.02% expense ratio, I love this section. I see that you have some massive growth here. I love Microsoft. Apple has great consumer behavior behind it with the purchasing power that they have, an ETF for diversification in the technology sector, and then you have some higher yielding older stocks like IBM and Intel. This by far has been my favorite sector that I've seen so far. I think you're doing wonderful here with the diversification and the amazing companies behind it. So the $1 Trillion Club, keep it up. I think that this is a great pie to invest in. Next, we have real estate. So real estate sector, you have Realty Income, as a lot of people have, including myself. You have Vanguard REIT Index Fund, and then next you have DLR, FRT, STAG, and LTC. So out of the 6 holdings and a 4.3% dividend yield, I think that this portfolio is okay in this sector. I think that you are diversified here between the REIT index, Realty Income I'm obviously very bullish on, DLR I love, FRT is the only one in this portfolio that I'm not too familiar with, so I can't really give much of an opinion there. Stag and LTC I'm not big fans of. I do think that they have hit a lot of recent issues with the recent recession, and it's not that they're necessarily bad companies. And I want you to watch my Wednesday's video because I'm going to be adding 2 REITs, and I want you to watch them and then see what I have to say about them and then give your opinion as to whether or not the 2 companies I'm going to be recommending on Wednesday are better than these companies. Now, these are not mistakes. I really like the real estate sector in general, but I do think that there are better companies to invest in, but I'm definitely not against it, but overall still not a bad slice whatsoever. You're doing great. So next we have healthcare. One company that I own in my healthcare sector, which is the only company I own in my healthcare sector, is Johnson & Johnson. It's your largest holding here, so great. You have an index fund, once again through Vanguard, great choice, AbbVie, and Pfizer. So if I were to own healthcare companies, AbbVie and Pfizer would probably be one of the first 2 that I'd be looking at. Great dividend yields for both of these companies. I don't really understand them a whole lot, and that's part of the reason why I don't mess with healthcare so much is because I don't like pharmaceuticals because I frankly just don't understand them. I can understand a lot of consumer and technology companies. I see their products, I understand their business model, but a lot of pharmaceuticals, I know nothing about making drugs or consuming drugs. So that is not really anything I'm interested in, but overall, all 4 of these are excellent. Excellent holdings, great holdings. So that sector is absolutely awesome, just like so far what most of these sectors have been. Consumer discretionary. So we have Starbucks, VCR, Target, McDonald's, Home Depot. All great picks. Starbucks I just added. I've considered adding Target, and then I own McDonald's and Home Depot as well. And once again, diversification with Vanguard. These are looking great. Next up, we have industrial. So I'm going to see 3M, Waste Management, Caterpillar, and then an ETF. So in my opinion, if you're looking for long-term growth, if you're looking for dividend and passive income, as far as the industrial sector goes, these are the three companies that you want to focus on. What I would consider adding, especially since you're focused on passive income, one that I would recommend that has a pretty high yield as well as great dividend growth, I would consider maybe splitting up some of your position with 3M and maybe try putting in Honeywell. But overall, these are some great holdings. I'm sure the index fund includes Honeywell as well, but overall, great holdings, diversification, good dividend yield, and a low expense ratio. Great holdings there. So far, I would say in the portfolio, I'm about halfway through, but really impressed so far, Joel. This is a great portfolio. A lot of times people send me their portfolios, and that goes for both of these, really. With Jose Gonzalez sending me his portfolio, and then Joel sending me his, usually I kind of expect a lot of people to send me their portfolios, and they have no idea what they're doing. They have a lot of mistakes. Maybe they have extremely high yield companies. Maybe they have a lot of risky sectors. But overall, with both of your guys' portfolio, I'm really impressed. So a lot of these companies that you guys have, I invest in as well. And if I don't invest in them, these are a lot of companies that made my B list, that where I've almost invested in them. So a lot of great companies so far. Financials, we have Visa, Vanguard ETF, JP Morgan, Bank of America, and Main Street Capital. So I'd say, first of all, as I see these top five, the fifth one here, Main Street Capital, a lot of people like Main Street Capital. I'm not really as bullish on them, but they definitely do have a great long-term potential ahead of them. So I'm not against investing in it. It's just not one that I personally like. It's not really my taste. But anyways, overall with the portfolio for this sector, I think that this is a great sector. I'm very, very, very bullish on Visa. Out of the two banks that I wanted to own, JP Morgan is one that I wanted to own, and I've considered adding Bank of America. So great picks there, as well as your diversification through Vanguard. If I were to recommend anything for this sector, I would probably drop Main Street Capital Corporation and probably just put it straight towards Visa or more towards your ETF. But that's just my recommendation. You cannot go wrong with all five of these holdings, so great picks there. Utilities, you have Southern Company, Duke Energy, Vanguard ETF, Dominion Energy, NextEra Energy. All five of these, fantastic. This is a company, Duke Energy, that I considered adding as well. I just wanted to put more towards Southern Company. I like their long-term history behind them. But these are great utilities companies with great dividend yields and some decent dividend growth ahead of them as well. Utilities are great, especially during a recession, because they're recession-proof type performance and stock price. So great picks there. AT&T, Verizon, Comcast, Vanguard Telecommunication Services Index Fund. All four of these great. I own two of these four, and Comcast is one that I've considered adding, a great dividend growth company. Like I said, so far with all these sectors, it's really hard to find a mistake because you have some great companies, a lot of similar companies that I own as well. And we can see here in the materials company, Lind and DuPont Nemours Incorporated, and then a Vanguard ETF. This ticker symbol DD here, I'm actually not too familiar with this one, so I can't really give an opinion, but Lind is a great company. Once again, great ETF, great sector. Next up, we have energy. So I'm not too bullish on the energy sector in general. A lot of people know that. But overall, if you were to hold energy in your portfolio, you want to own the two big dogs. I made an entire video dedicated towards energy companies and energy stocks in 2020. If you are going to own them, if you're forced to own them, own these two because these are the two big dogs you want to own. And then you have some diversification with an ETF there. So great picks there. And then last but not least, we have 1% in bonds. I've mentioned before that I've considered adding bonds to my portfolio. One of the two that I like is TLT and EDV. I'm not too familiar with these ETFs for bonds, but I'm sure these are great because they're Vanguard, and anything with Vanguard is going to do just fine. For me personally, I like long-term treasury bonds. I don't like corporate bonds. That's just the way I am, but I think you're going to do great with these holdings. And overall with the portfolio, fantastic job. Amazing job. You're extremely diversified. You have a great dividend yield, a very low expense ratio. Joel, you are doing amazing. Keep up the great work. It's hard to even recommend anything that is wrong with this portfolio. I would say one of the only recommendations I can give for this entire portfolio, and it's hard to even find a mistake, and not that this is even a mistake. I'm not too bullish on these companies. This was one of the only sectors that I saw that if you're going to get some consumer companies, there's a lot of older long-term companies that you could replace these with. I think Walmart's low dividend and Walgreen Boots Alliance is risky play that we have this with this recession and their management decision. I think there's probably some better consumer companies you could add out there, but regardless of what you do with those consumer companies, overall, fantastic job. Fantastic job with this portfolio. I think you did wonderful. But overall, Joe and Jose, thank you guys so much for seeing your portfolio. Anybody watching that would like me to review their portfolio, go ahead and send it over either to my email, it's in the description of all of my videos, or leave it down in the comment section. I would love to review anybody else's portfolio that would like me to. Like I said, if you want to use my referral link down in the description, you can go ahead and use this referral link. It's down in the description. You can get $10 for getting started with M1 Finance. And the 2 companies that I will be adding in my portfolio, I'll be making a video about it Wednesday. I am selling 3/4 of my position in IBM and half of my position in AT&T, and I'm replacing them with 2 real estate investment trusts, which is WP Carey and Store Capital. So I'll be going over that Wednesday for those of you that are interested, and I do have some big buys and sells coming up. So thank you guys so much for watching. If you made it all the way to the end, make sure to leave a comment section down below what you thought about this video, what you thought about my opinions on their portfolio, and what you'd like to see from me. So thank you guys very much and have a great day.